Welcome back to AlgoBot, the channel where we break down automated trading strategies for MetaTrader 5, one expert advisor at a time. I'm your host, and today we're studying a strategy called Walsh Baseline Trend Reclaim. It's a with-the-trend pullback approach, but the part that makes it stand out is the baseline it trades around, a robust, spike-resistant fair value line borrowed from classical statistics. By the end of this video, you'll understand how that baseline is built, how the strategy reads the trend when it signals an entry, and how it manages risk. Let's get into it. So what exactly does this expert advisor do? At its heart, Walsh Baseline Trend Reclaim is a trend-following pullback strategy. It waits for a clear directional bias, then looks to enter on a shallow retracement back into value rather than buying or selling into an already extended move. The engine that defines value is the Walsh baseline, a robust central tendency line drawn from recent closing prices. Most pullback systems anchor themselves to a moving average, a simple average, an exponential average, or perhaps a median line. The distinctive choice here is the Hodges-Lehmann estimator, the median of all pairwise averages of the recent closes. In plain terms, it delivers roughly 95% of the statistical efficiency of a normal average on clean data, yet it has a breakdown point near 29%. That means almost a third of the data could be wild outliers before the line is seriously distorted. For a foreign exchange chart full of news spikes and erratic wicks, that stability is the whole point. A calmer baseline means cleaner pullback signals and fewer of the whipsaw entries that tend to drain pullback systems. The strategy is fully symmetric. It treats long and short setups with identical logic, just mirrored. It's designed with liquid instruments in mind, such as major foreign exchange pairs and metals, on time frames around 15 minutes up to 1 hour, though nothing in the code is locked to a particular time frame or symbol. Who is this style suited to in an educational sense? It leans toward traders who prefer a patient, rules-based, with the trend approach and who care about controlling drawdown through tight, structural stops rather than chasing every move. As always, this is a study of how the code behaves, not a recommendation, and not a promise of any outcome. Trading carries real risk, and losses are a normal part of it. Let's walk through the mechanics step by step. Everything in this strategy is built on a single line called the Walsh baseline. To build it, the strategy takes the last 24 closing prices, that's the WindowLen parameter, and forms every possible pairwise average between them. Those pairwise averages are known as Walsh-averages, and the strategy takes their median. That median is the Hodges-Lehmann location estimator, a value that sits at the center of recent price but is remarkably resistant to outliers. A single news wick or spike bar barely moves it, which keeps the line calm and steady. Next, the strategy measures the trend. It compares the baseline now to where the baseline stood a number of bars ago, set by SlopeMinAtr, which defaults to 6. The difference is the slope. Because both endpoints are spike immune, this slope is a very stable read on direction. The slope must clear a threshold, SlopeMinAtr multiplied by the current ATR, before the strategy accepts that a genuine trend exists. If the slope is rising and clears that threshold, only long setups are considered. If it's falling past the threshold, only shorts. If neither, the strategy simply stands aside, and that single filter screens out choppy, directionless markets. Let's read the actual MetaQuotes code the expert advisor runs. At the top are the inputs. WindowLen sets how many closes build the Walsh baseline, defaulting to 24. SlopeLen and SlopeMinAtr define the trend filter, how far back the slope is measured and how steep it must be in ATR units. ATR period drives the volatility unit used for thresholds, stops, and the trail. Stop buff ATR, entry max ATR, and max risk ATR shape the entry and its risk, while reward risk, break-even ATR, and trail ATR govern the exits. Now the long block. The condition reads, if uptrend is true, and the close bar's low dipped to or below the baseline, and its close came back above the baseline, and the candle body is bullish, and the close isn't already more than entry max past the line. When every part is true, the strategy computes the stop just below the bar's low, checks the risk is within limits, sets the take profit at the reward to risk multiple, and calls trade.buy. The short block is the exact mirror. If downtrend is true, the high poked above the baseline, the close fell back below it, the body is bearish, and price isn't overextended, then the stop sits just above the bar's high. The take profit is placed below at the same reward-to-risk multiple, and the strategy calls trade.sell. Notice both sides share identical structure, only the direction flips. That symmetry keeps the behavior consistent whether the market is rising or falling. Let's bring the logic to life on this chart. On the price candles, you can see the Walsh baseline drawn as the blue line weaving through the middle of the action. Watch how smoothly it moves. Even when a candle throws out a long wick, the line barely reacts. That calmness is exactly what the robust median gives us. Start on the left. The first two candles push higher, and the baseline is quietly sloping upward beneath them. Because that slope is rising and clears the ATR threshold, the strategy has established an uptrend, so from here it's only interested in long setups. It now waits, patiently, for price to come back to value rather than chasing the rally. On the third candle we get exactly that. Price pulls back and the candle dips its low right down to the baseline, tucking briefly beneath it. This is the pullback into value the strategy is looking for. But notice the candle doesn't close weak. It recovers and closes back above the line with a bullish body, and it isn't stretched too far above the line. Every entry condition is satisfied, and you can see the buy entry marker appear on that reclaim candle. The stop is tucked just below that candle's low, giving the trade a tight, structural risk. From that stop distance, the strategy projects its take profit at the reward-to-risk multiple of 1.6. Now follow the next candles. Price lifts off the baseline and the uptrend resumes, candle after candle printing higher highs. As price climbs, once it moves far enough into profit, the stop is lifted to break even, so the trade can no longer turn into a loss, and an ATR trail begins to follow behind. Price continues higher until it reaches the take profit target, and you can see the take profit marker complete the long trade. That's one full cycle, patient trend confirmation, a pullback reclaim entry, and a managed exit. Now the market changes character. Near the top, the candles stall and roll over. The baseline flattens, then begins to slope downward. Once that downward slope clears the ATR threshold, the strategy flips its bias. Now it's only interested in short setups, and it waits for a pullback back up to the line. Watch the reclaim candle on the middle right of the chart. Price rallies up into the falling baseline, and the candle pokes its high above the line, but it can't hold there. It closes back below the baseline with a bearish body, and it isn't overextended below the line. This is the mirror image of the long setup, and the sell entry marker appears on that candle. The stop is placed just above that candle's high, again a tight structural distance, and the take profit is projected below at the same reward-to-risk multiple. From there, price rolls over and the downtrend takes hold. Each candle carves out a fresh low, the baseline keeps sliding down above price, and once the move is far enough in profit, the same protective machinery kicks in. The stop moves to break even and then trails behind price as it falls. Finally, price reaches the downside take profit target, and the take profit marker closes out the short. Step back and look at the whole picture. The same simple idea handled both trades. Let the robust baseline define the trend, wait for a pullback that reclaims the line, enter with a tight structural stop, and let the break-even lock and ATR trail manage the rest. Because the baseline shrugs off spikes, the pullbacks it flags tend to be genuine tests of value rather than noise, and that is the core educational takeaway of the Walsh baseline trend reclaim approach. Let's wrap up. Today we studied the Walsh baseline trend reclaim expert advisor for MetaTrader 5. We saw how it builds a robust Hodges-Lehmann baseline from recent closes, how it reads the trend through the slope of that line, how it enters only on a pullback that reclaims the baseline, and how it protects each trade with a tight structural stop, a break-even lock, and an ATR trail. Remember, everything in this video is educational content only. It is not financial advice, not a recommendation, and not a solicitation to trade. Automated strategies can and do experience losing trades, so always study, test, and manage risk carefully. If you found this breakdown helpful, please like the video, leave a comment, and subscribe for more MetaTrader 5 strategy analyses. You can find more at www.algobot.live. Past performance does not guarantee future results. Trade responsibly.